Hi there, this is Christian Dye from Latitude West Financial, and it is May 21st. And today we'll be talking about capital gains tax changes coming and proposed for June 2024. I've got with me Nathan Morrison, our CPA, and Stuart Ross, our LLP legal advice. And so, what I wanted to do is to use this session to leave enough time for a lot of questions and answers because I know a lot of people are worried about what are these changes, how are they going to affect them. So one quick disclaimer is that the information given today is not to promote any sort of buying or selling of any assets, nor is it any direct tax or legal advice. We want you to do your own research because every scenario is different, which is why you'd want to reach out to your own team. Today is just for educational, informational purposes only. So I want to dive right in and I want to talk about what are the changes and the implications. We're going to have Nathan, our accountant, our corporate CPA accountant, to kick us off here.
Okay, thanks, Christian. Okay, so I'm gonna fly through these slides pretty quickly. Christian, if I'm not going fast enough, you're gonna push me through. Capital gains inclusion rate has changed a number of times. Prior to 1972, as you can see, there was no tax on capital gains, and we've had about 4 or 5 changes since then. We've been at 50% for the last 24 years, and the proposed increase jumps us up from 50% to 67%, with a start date of June 25th, 2024. Reasons for these change. So, why are capital gains given this beneficial 50%, soon to be 67% rate instead of 100%? The biggest reason is the government really wants to incentivize investment in potentially risky ventures. And the basic idea is as you're investing in capital, the capital gains return is not guaranteed or not assured in the same way as interest or rental or dividend income is. And in addition, when you look at how these gains come in, most capital gains occur over a long period of time, and in reality, the portion of that gain is really just inflation. It's not really a gain at all; it's inflation. And so, if they were 100% taxed, there would be a real lack of integration when we look at other types of investment income. So it represents, in a sense, your after-tax income, and it's really a way of avoiding double taxation. But what is the right rate? That is a question that is a little complicated, and we don't have time to discuss today. You can give me the next slide, Kristen. So who will be affected? A lot of Canadians are going to be affected. Rental property owners, stock portfolio holders, vacation property and second homeowners are going to be kind of caught by surprise with this one. Business owners with significant gains, specifically incorporated business owners and professionals, estate taxes, and are going to, at this point, are going to be impacted in the exact same way that everybody else. So there's no specific carve out for estate taxes. And individuals leaving Canada. So on your way out of Canada, there's essentially a deemed disposition of all of your capital property. Oh, we switched me. So they're going to get impacted as well. So what are the actual changes? The inclusion rate, as we saw before, is going up from 50% to 2/3 rate at 67%. And interestingly enough, there's a annual $250,000 annual allowance only for individuals at this time. Now, that's not an exemption from tax, which is a question I've got from a lot of people. But what it means is for an individual, every year you can have the first $250,000 of capital gains is still treated at 50%, not at the new 2/3 rate. However, this allowance does not exist for corporations or trusts, which is going to present some interesting integration issues in the overall taxation. There's also no special rules on death, and so estates are included there. And the other interesting point here is these changes have come in, they've been proposed, and they're scheduled to come in June 25th, but we've not actually seen the draft legislation. And so at this point in time, we really have limited information on the details of these changes and how they're actually going to flesh out when all is said and done. What's next? Impact on tax rates. Okay, so what are we actually talking about? What's actually going to happen here? So comparison of old rates and new rates for individuals and corporations. Individuals and trusts, as trusts are taxed as individuals, essentially. The overall increase on a capital gain is going up from 26.75 to 35.67. That's almost a 9% increase on the entire gain. Corporations are going up from 25 to 33%. That's about an 8.5% increase. So what does that actually mean? The actual increase on a $100,000 capital gain for an individual or trust will be an additional $809.20, not including the first $250 annual allowance that we mentioned earlier. For corporations, you're looking at about $8,400. I'm good. Here we are. Should you rush to trigger gain before June 25th? Why would you go trigger a gain? Some of the reasons you would consider doing that is you've got an already planned sale. So I'm looking at selling a property next year, and I'm going to try and sell it now before these changes come in. If you're looking at leaving Canada next year or in the near future, you might want to see if you can leave a little earlier before these changes come in. Elderly individuals or individuals with an upcoming forced realization of assets may want to consider bumping that timeline up. Why would you not trigger? Well, I think the biggest reason is if you trigger a gain today to take advantage of the 50% inclusion rate before the change, you're likely putting yourself in a position where you're gonna have to pay a whole bunch of tax, and you're gonna prepay that tax, and you're also gonna have to come up with the money because there's likely gonna be no sale. If you're artificially triggering a gain, there's no sale to a third property, and so you're in a place where you need to come up with some cash to pay that tax, and cash is not always available. You get a short window to sell, which means you're going to have a hard time getting fair market value. And there's the potential that this inclusion rate could be changed. I mean, between now and June 25th, or we have, I think in 2025, we have a potential government change that could be changed. We've seen changes like this happen. We get a draft legislation for new rules. 6 months later, we have some big changes. So we really don't know what's going to happen with the absence of the draft legislation. My conclusion at this point is I think most taxpayers are going to be unlikely to trigger gains before June 25th. It'll make sense for some, but for a lot, I don't think it will. Short-term strategies. You do want to make a change. What can you do? You could immediately sell your assets, and that would be like a third-party sale. You could look at an estate freeze, which is a tax planning tool that's been around a long time. You could look at transferring your property specifically to a spouse or a corporation. Both of those transfers through a couple of vehicles can be done either at cost or fair market value, which one thought on that is you could make the transfer and wait until after June 25th to make a decision on whether you're going to make that transfer at cost or fair market value. Those are kind of some of the immediate short-term strategies available to you. Long-term strategies, a little different, spreading the gains amongst different individuals and specifically different years. Utilizing that annual $250,000 allowance as an individual is going to be something that may become very valuable. Maximizing your registered investment accounts, RSPs and TFSAs. Nothing new there, but again, when these tax changes come in, it always makes us think about that. Shift your portfolio towards higher dividend paying investments. So rather than looking for the long-term gains, maybe you start looking for some more annual dividends. Investing in a corporately owned permanent life insurance policy. The benefit of that permanent life insurance policy is you can dump extra funds in there and it can earn investment income on a tax deferred basis inside that corporation, therefore avoiding these new rules. Business income versus investment income, depending on the situation of your investment income, sometimes we can look at claiming that as business income versus investment income. But that's much more, we don't have time to go into that one. What do we got next? Oh, a couple other quick things. 2 additional changes to the budget. They've increased the capital gains exemption from Is that right? 100. I think that slide is actually wrong. I think that's 1,016,000 to 1,250,000. And they've increased the home buyers plan. That was probably my fault. Sorry about that, Christian. Increased the RSP home buyers plan from 35,000 to 60,000. So those are two interesting changes that I think people are going to take advantage of this year. Key questions. What don't we know? We don't know a lot. Will the inclusion rate increase will it increase as planned? We're not sure, probably, but it may not. What about future changes? Is that inclusion rate going to go back down to 50% next year? Is it going to go up to a higher rate? We don't know. This is a big one. The $250,000 annual allowance for individuals. It'll be interesting to see what happens with this, and maybe this will be expanded to include corporations and trusts, or specific types of trusts at the very least. Possible exemptions upon death. So estates, is that allowance going to be expanded to estates? And treatment of prior year's gains, and just general speculation, what's next? What are future tax changes? So I think that's my last slide. That was a lot of information to get through, but Christian, I'll kick it back to you.
Sure. Thank you. And we're going to take questions at the end. So if we wanted to just make sure that we left enough time for questions. And then, so if you do have a question, write it down, save it for the end, throw it in the chat, and then we'll address it. I want to shift gears a little bit about if you were going to trigger capital gains, is it possible to trigger it without selling the asset? And what are the reasons why to do something like that? So I'm going to shift it now to Stuart and to field this question.
Yes, thank you, Christian. As mentioned, my name is Stuart Ross, and I am the managing lawyer at the law firm of Garton & Harris, which is located in Port Coquitlam. And I handle the majority of the office's complex real estate and corporate transactions. So, Christian, thanks for the invitation tonight. Yes, as alluded to, this would fall under the general umbrella of what Nate was mentioning earlier about intentionally triggering capital gains. If you trigger your capital gain before June 25th, you pay it the lower rate of the 50% as opposed to having 66% included in your income. However, if you're like a lot of investors, you might be a little bit loath to actually dispose of your capital assets. They're going to continue to increase in value, you generate income from them, and you had costs of acquisition that you don't want to invest in a new property. So if you're looking to trigger the gain and pay on the 50% as opposed to the 66% inclusion rate, can you still keep your property? Yes. Now, this wouldn't fall under the general umbrella of what Nate was mentioning, and that is an immediate sale of the property. However, in this case, it is somewhat of a, we'll call it a legal and tax fiction that you're actually selling the property. So in this particular strategy, what you would do is more or less sell the property or transfer the property to yourself or an entity that you control. So as mentioned, this is the general bare trust strategy that is employed. It's not just in this is kind of a unique situation for this year because we've been at a stagnant capital gains inclusion rate for the last almost 25 years. But this is used for other reasons, but it does apply here. So this is more meant as the slide here is somewhat of a recipe for how you can intentionally set up a bare trust to intentionally trigger the capital gains tax at the current inclusion rate without actually truly disposing of your property. So step one, and this doesn't necessarily happen to be for real estate. This is kind of geared towards real estate, but doesn't have to be that way. So number one, you set up probably a new holding company. So you go set up your XYZ Corp. You are then going to transfer what is referred to as the beneficial interest in the property to the holding company. So you're not going to transfer, as I mentioned a couple points down, you're not going to transfer the legal interest. That is, you're not going to transfer legal title to the property to this newly created company because you would incur property transfer tax. So what you would do is you would create an agreement between the current property owner, and it might be yourself individually, or it might be another company that is currently holding the property. And what you would do is you would transfer the beneficial interest in the property to this new company. So you would say, I sell you the beneficial interest for probably whatever the equity in the property is, and then that would be captured in the 50% inclusion rate. You would do this through a written agreement in case CRA ever asks, where you'd say company ABC transfers to company XYZ, and you state that they're going to transfer the beneficial but not the legal interest in the property. And then the current owner of the property now becomes what would you be called a bare trustee of the property. They no longer have any legal or financial interest in the property, but they just remain registered on title as the legal title owner. And as mentioned, this is so you don't incur property transfer tax. So now that basically brings us down to the last point here. As I'm sure anybody that has had investment real estate knows, or real estate registered in the name of a company over the last few years, you probably got a letter from the land title office saying that you are required to file a land title transparency registration, which basically sets out who the shareholders of your company are, whether they're Canadian. It's more of just an attempt at the foreign buyers kind of thing that the province is getting at. So if you employ this strategy, what you would need to do is file an amendment at the land title office to say that the current owner of the property, say if it's yourself personally in your individual name, that you are now holding this property as a reporting body. You would be a trustee, a bare trustee, but you would be a trustee holding this property in trust for your newly reported corporation. I'm imagining that there's a lot of people that might try and employ these strategies on their own, that actually wouldn't file their registration with the land title office. The difficulty that this might create is I'm envisioning a situation, and the vote's still out on this, but if people decide come August that, wow, I really wish I had triggered my capital gains, is that they might try and backdate a transaction. And now that might be possible if you had a shelf company or something like that to backdate a transaction to June 24th. But if anybody ever asks, well, where's the land title transparency registration, you wouldn't have had that filed on the actual date of the transfer. So they might consider that to be some sort of an invalid transfer, say that it doesn't qualify, or that you're trying to use the general anti-avoidance rules or something like that. Nate could probably give a far more eloquent explanation of the potential issues that could arise if you're trying to backdate something, especially with there used to be no requirement that you'd register this bare trust, but now there is. So you used to be able to more easily get away with backdating a transaction so long as you did it prior to filing that year's taxes. However, here, now that with this land title transparency registration, you should probably make it happen hand in hand with when you actually transfer the beneficial interest. So that's more or less the how-to of how you could trigger the capital gains and not actually dispose of your capital asset. As mentioned, you'd then pay on 50% of the gains you accrued from the date you acquired the property up until June 25th. You'd still be on the hook for the larger balance post any gains you incur post June 25th, 2024. So this strategy would probably work best for somebody that has a really large embedded capital gain, several $1 million or something like that, that they have to pay, or something like, because you'd still do it at the lower rate. Can we go back one, Christian? Okay. The caveat that I'll flag here is that if you intentionally trigger the capital gain, you're going to have to think prior to doing so, because you're going to have triggered a capital gain but not actually sold a property. So you're going to have to come up with the money to pay the tax bill. Sources of that, I don't know, probably talk to Nate or something about that, about where you could draw from in the most tax advantageous manner. But keep in mind, when you pay capital gains, it's usually you have the proceeds of sale to pay your tax bill. Here, you wouldn't actually have any proceeds of sale from the sale, because you've done a kind of an artificial sale here of the property. So you'd have to think about whether you're going to refinance, whether you got cash on hand, how much that bill is going to be, and whether you can spread out that payment in some way or another. So before actually jumping to this, you need to figure out, are you going to be able to foot the tax bill for next year's taxes? And okay, so and I think as Nate alluded to in one of his files there, we don't actually know if this is going to go forward. The federal government has severed the capital gains amendment from the balance of the budget for perhaps some political strategy or something a little more cynical. Why would they do this? Well, I'm imagining it's the likely intentional to provide taxpayers with as little notice as possible to make effective tax planning arrangements. So if they don't come out until the last minute, it's gonna, call the herd as far as how many people are going to be taking steps to reduce their tax bill. So long and short of it, that's how you could intentionally trigger without actually selling your property. I do plenty of these types of transactions for various purposes. So my contact information is on the slide. So if anybody wanted to reach out and ask further questions or discuss costs or anything like that, I'm more than happy to discuss. So thank you.
Yeah, sure. Thank you. And I'm going to expose everybody's contact information at the end when we're doing the Q&A. So save your questions till the end, and there's going to be lots of opportunity to reach out. And I'm sure all three of us are happy to take a complimentary call if somebody would like to know a little bit more about how we could help them. So last part over here is what solutions exist for people who are incorporated or people who are investing. So I'm not going to go into too much detail. I'm just going to try to describe some of the things that we're doing with our clients. So for some of you who are listening who are not clients already, just a reminder that Latitude West, we're a little bit of a unique financial advisory firm because we do the traditional, insurance and investments, but then we do some things that aren't so traditional, which we go deeper into the planning, including, we call it tax guidance. As well as real estate guidance. Since we're not realtors and we're not accountants, but this is an area that we tend to specialize in providing guidance. We would work with your accountant, regardless of who that is, in order to say, here are some strategies. Let's involve the accountant and see if we could all implement this. Same thing with the real estate. If there's some real estate strategies, let's involve the realtor, the mortgage broker, or whoever happens to be, and let's figure out, what is the best way to either preserve capital or add more assets to it. And that's what makes our company unique. So a lot of our clients, are incorporated physicians, incorporated dentists, and they're wondering, is it still worth it to keep my corporation, or is it still worth it to keep investments inside of it? The quick answer is typically yes. We could go into further detail off of a separate conversation as to the reason why, but everyone's individual situation is going to be different. Paying an upfront cost of taxation is never a good idea. If there was a short-term need to, I'm going to sell something, or I need the cash really, really quickly, then maybe. But if we're looking in the long term, deferring your tax bill is probably the best thing possible as opposed to paying something up front. So now I'm going to use a couple examples. First one is going to be somebody who invests inside their corporation. Now, it could be stocks or it could be real estate. A lot of our clients invest in real estate, so I'm going to use real estate as an example. So let's say you have your personal residence plus another 4 properties. So it's 5 properties in total. Now, because of the one is personally owned, there will be a capital gains tax-free exemption, but unless, of course, they change the rules there. But let's say the other 4 are corporately owned. And so what we would do is to calculate what is the cost when they first purchased it, and what is the fair market value now, and also what is the fair market value typically going to be when they eventually sell or when they pass away. We would then say, is there a strategy now that the capital gains has changed where we can, complement this to minimize the taxation? So the first thing that we do is we would calculate what is the potential capital gains tax bill. So for argument's sake, let's just say in year 1, there's only a couple $100,000 of gain, but in year 50, so let's pretend this is a 35-year-old and this 35-year-old passes away at 85. Let's say they kept all of their assets inside the corporation, the value increases, which we can help to calculate. So now let's say there's going to be a capital gains tax bill of about $3.7 million. Well, how can we pay for this capital gains tax bill? Well, one method is to, of course, sell assets. Now, in order to sell enough assets, those assets are, of course, gonna have to pay a big tax bill as well. So we calculated how much assets you would need to sell. The other thing you could, so in this scenario, it's about 5 million. The other one is to borrow. Okay, well, instead of selling the assets, why don't I leverage against that? And then I just got to fund the loan. So in this scenario, we estimate that to be about 4.7. But then we had our estate bond corporate strategy. And Nathan had already alluded to this in one of his slides. He says, what you might want to do corporately is to have a permanent insurance policy. That defers the capital gain, which allows you to leverage against it tax-free, which pays out a death benefit tax-free, but then also comes, and we didn't really get into it, with the CDA credit. And we haven't talked about the CDA credit, but the capital dividend account, which is a credit inside of a corporation, allows money to flow out of the corporation into the estate tax-free. Now, if these changes go into effect, that's reducing from 50% down to about 32%. So right away, your tax bill is going higher and your CDA credit is going lower if you're incorporated. So now it would be great if we had a product which actually has a large CDA credit, which grows over time, which is not affected by these changes. And that's what an estate bond is. So an estate bond is essentially, it works like a bond, but it comes through an insurance company in the form of a permanent life insurance product with a dividend that's cash value. And so these aren't going to be affected by the next changes. So does it make sense? And in this particular example, which I've used, the answer is very, very quickly, yes, it does. Because all we're doing is shifting money from a stock bond portfolio to a stock estate bond portfolio. All we're doing is saying, let's get some more tax efficient investments inside the corporation. Of course, what we want it to do is to be able to wash out the capital gains tax bill waiting for us, as well as build enough CDA credits to bring other assets to come out. So this over here is a quick little graphic of a stock bond mix versus a stock estate bond mix. So the stocks are going to keep growing, or the real estate, whichever one you want to call it, they're going to keep growing. But especially if the changes come in, now we've got this fairly large looming capital gains tax bill. So you might say, oh, you know, my net worth is fantastic, it's worth $10 million. But if we do the planning together, we might realize that we might end up losing 30% of that to taxation alone. Whereas if we were to implement a strategy, such an estate bond strategy, we might be only losing 10% of that. Okay, or potentially even less. And so I always like to say, I don't mind paying my tax bill, I just don't want to leave a tip. And then for people who are having assets come out, you said, well, you know, I don't want to leave too much to my kids. The alternative is leaving, if you're not going to leave that much to your kids, you're basically choosing to leave more to the government. So in essence, as long as you're not going to die penniless, that means there has to be assets that have to be passed on, whether they be corporate or whether they be personal. You just want to say, how much of a tax bill do I want to have to pay? Which is why you want to do some planning. And then you want to use a strategy such as this. So what we did, and whenever we deal with a client, we always figure this out before we commit to anything, because they want to know, what are the numbers if I was to implement this strategy? So we would always say, what is the net amount lost to taxes? And what is the amount that we're saving by implementing the strategy? What are the rates that we're getting? So this would be one idea of how to implement a long-term strategy if we were going to continue to incorporate and continue to hold assets inside that corporation. I highly recommend an implementation of an estate bond strategy. Now, what if you were realizing the gain, whether it be now or whether it be later? Is there anything we could do to kind of mitigate it? So our second idea that we work with our clients are flow-through shares. And flow-through shares are essentially, it's a type of a stock share, just like any other investment, but you have to be licensed in order to get these, first of all. So you can't really buy them on your own, or it's not easy to buy them on their own. And I also wouldn't recommend that you ever try to buy these on your own. You would only ever try to get flow-through shares if it fit with your need. because this is a very, very volatile investment, and you have to understand what is the tax savings by doing it. So not all flow-through shares are created equally, and they're definitely not for everyone. But to make a long story short, what they are is a type of an investment you would make in the year that you realize a large capital gain. What's going to happen is that the government gives a very, very, very large credit because you bought those flow-through shares, even if they have lost money. So, for example, this person has investment income over $300,000. They're incorporated. They have they buy $100,000 of flow through shares, and then they end up redeeming them at a value of only 80%. So they've actually lost money on the flow through shares. But because the tax credit was so large, in year one, they were automatically given a $47,000. Sorry, they were given a credit equivalent to $100,000, but in actual savings, it saved them on taxation of about $47,000. So that means even though they invested $100,000, because of the savings, they actually only invested $52,000. Now, so from a cash flow perspective, they're out $52,000 in the form of the investment. Now, in year two, they lost $20,000 in the investment in the form of $80,000. But from a cash flow perspective, because of the tax savings, they actually were $64,000 better off. So what we realize is these flow-through shares, because they essentially invested 52 and got 64 out of it, they actually had a 23% return on the investment. And there's also a rollover in the tax savings. So in year two, they get a little bit of extra. So the 23% is actually 28%. So that's a very, very, very quick version of why you might want to consider flow-through shares. But as I've said, do not run out and go buy these things. Work with a company, work with advisors that understands which are the best ones and how to structure them. So those are two different ideas of what you might want to think of. So what I want to do is I want to leave enough time for questions, but I want to talk a little bit about my philosophy of planning, of growing wealth. And many people, of course, have heard this before if they've ever heard me talk. We believe that you should be growing wealth in three main asset classes. One is the stock market. There's nothing wrong with the stock market. We like the liquidity of it. But the other one is in the real estate market. We are a real estate focused financial advising firm. We have a lot of clients who are very pro real estate and want to grow their wealth in real estate as well. And our third asset class is some sort of a fixed income reserve or an insurance, which allows us the safety, the stability, the ability to bring in more CDA credits, also the ability to leverage gains so that we don't incur any capital gains, but at the same time into safe assets that we're investing in. So we find that all three of these move really, really well together. I described this more in a book that I just recently published. It's available on Amazon if you want to go look at it, or if you want to just connect with me, especially if you're a client, I'll just send you a copy if I haven't already. So it talks about creating wealth through real estate and the advantages of it. And there's so many tax advantages of creating wealth through real estate, especially if we're incorporated. So feel free to go out on Amazon and go pick up a copy, or to just connect with me and I'll probably just send you a copy. So what does Latitude West do for those of you who are non-clients right now? We always start with a discovery meeting. And if you want to see what is the type of things that I can do to help you in your situation, one of them absolutely is tax. Can I find any way to minimize your taxation? Second thing is, can I find any way to grow your wealth? What differentiates me with all of the other advisors out there who do a great job, but I find that they tend to do a great job solely in the stock market, mutual funds, TFSAs, RESPs, whereas I do a great job in both the stock and the real estate market with a heavier emphasis on the real estate market. This is both passive and active real estate. So if you feel that you'd like to learn a little bit more about my planning, I'm going to ask you to feel free to reach out. All of our discovery meetings are completely complimentary. So now, again, we finished with enough time to field questions. So if you did have a question, the way I'm going to narrate it is to put it in the chat, and then I will field the question, and then we can all sort of answer them. While we're doing that, if anyone wants to reach out to us, you can do that by connecting with us. Myself at cdy@latitude-west.ca, Nathan at nate@nlmpca.ca, and Stuart at sross@ gartonandharris.com. So with that, I'm going to kick off one of the first questions while people are formulating their questions, and then you guys can kind of, jump in. So if somebody had a large real estate portfolio and they were quite old and they wanted to pass this on to their kids and they don't want to trigger the new capital gains, we've already talked about several different ideas, but maybe we could each take turns. Would you consider triggering the capital gains now, transferring the asset to the adult children in some way? And if so, which way would you do? Or would you be better off saying, no, leave everything as is, don't trigger the upfront capital gains, but to just hold the asset? So who would like to start with that question?
I'll jump in just quickly. So I think the first thing I would say, if you've got an elderly individual, first of all, if they have if there's a surviving spouse, and the idea, is you're going to wait until both spouses pass away to pass those assets on, that would be just one thing to consider, because those assets can transfer on a tax-free basis upon death to the surviving spouse. So just one thought in there. But I think to answer your question, I think, Christian, it would really, from a tax perspective, it would come down to the timing, and you probably have to get into some number crunching to really make that decision from a tax perspective. Like, is it, when are we thinking, what's your best guess on how long we're going to be, when this property is going to be transferred due to the individual passing away? Is it 5, 7, 10, 15 years? And I guess the other question would be, and Stuart, maybe this is one more for you, but I think the other question would be, is this individual ready to give up control of those assets? Because that's obviously a big issue as well. But I think you have to crunch the numbers, and I think you'd find that you're looking at probably somewhere between 4 to 7 years. If it's less than 4 years, I think it's going to probably make sense to do it now. And again, don't hold me to that. If it's greater than 7, it might not make sense to pay that taxes. And again, those are just kind of random numbers, but I think that's going to be the timeline you're going to be looking at.
Yeah, with respect to giving up control, I mean, I think you could do that in similar to the same way that we were talking about before. You could effectively transfer the growth shares, or set up a new company or a family trust or something like that, where the growth interest accrues with the children or the next generation or whomever they wanted to benefit. However, have the voting shares or the control shares of the company or the trust rest with the parents, so they would still get to make the decisions, but any future growth in the underlying asset would accrue to the children.
Okay. Yeah, like I guess my follow-up question is, let's just say they wanted to trigger it. Would you say triggering it and changing title, or trigger it, set up the holding company, and have them own shares inside the holding company?
Well, I'm hoping that, like, I guess at the end of the day, that most people, it's not always the case, because I mean, I encounter it quite frequently where it's not, but I'd hope with a lot of people that they would have assets or real estate, if we're talking about real estate, that they would have their assets already registered in the name of a company. In that case, it's a lot easier to make changes behind the scenes. If it's registered in an individual person's name, then you always run into the issue of paying property transfer tax when you do it. However, with that being said, if you're looking long-term enough, I would still say maybe to consider biting the bullet and transferring it now to a company, for a couple reasons. One is that property values are always continuing to increase, and you always pay property transfer tax on fair market value. So if you wait to transfer it, there's just going to be that much higher of a value and that much higher property transfer taxes. Furthermore, if you're looking a little bit more long-term as well, if somebody dies, then you're also going to pay probate fees in addition to capital gains and property transfer tax when you transfer it out of there. So if you get it into a company, there's ways that you can also avoid any probate fees whatsoever on those corporate shares. I'm happy to talk about that with any, but there's this new, well, not so new anymore. It's about a decade old now. There's these things called restricted wills. So you can put any corporate shares into a restricted will and you'll never pay probate on those shares. So yeah, you might be biting the bullet now with intentionally triggering the tax and the property if it's in your individual name, but you could avoid it down the road for your beneficiaries. You just it just your beneficiaries that realize on it and not yourself.
Yeah, like I guess my view is that it comes from a more of an opportunity cost real estate view. Let's say you were to have this large asset, as you guys mentioned. If you not sell it, but just trigger the capital gains and transfer it, let's say those capital gains are $100,000, for example. It says, well, I'd rather pay $100,000 now than let's say 150 later or 200 later. So I'll trigger them now. But if you're going to hold the asset for, let's say, even 10 years, and then you calculate, is it cheaper to do it now versus later? On paper, the answer is yes, if you just look at it from a capital gains accounting perspective. But if you look at it from an opportunity cost perspective, what is $100,000 worth in the future if I saved on it today? Well, by paying that $100,000 now in capital gains, but you didn't sell the asset and now you've transferred it. Well, what if I kept it and kept my 100,000? Because the 100,000's got to come from somewhere. Let's say you're freeing it up from one of your investments. Well, now that investment stops growing. So the opportunity cost is the loss of whatever that investment 100,000 would have grown to. My mind is even going towards, well, what if I just had the cash, Christian? So it wasn't being invested anywhere anyway. So why don't I just pay this because I'd rather do this than pay the tax later? Yeah, but what if I took that same 100, which wasn't going anywhere? And for real estate investors, we like to invest in more real estate. So what if that 100 was now a down payment on a $400,000, $500,000 property? Well, in 10 years from now, that equity amount might far, far, far outweigh the capital gains extra tax bill that you're incurring. So that for me is my perspective. What are you losing out with the opportunity cost by paying more money right now? But if we were able to kind of have your cake and eat it too, which was trigger the gain, but at the same time try to offset it using some other asset or some other form, that would be great. But then again, we'd have to look at planning, because what I'd be looking at is what's the most inefficient money right now? What is the money that's sitting there that's not doing anything, or it's very, very low yielding? Or if I know there's this big tax bill and you've got a whatever 1.5% high interest savings account with the money not going anywhere, maybe that is a good way to utilize the fund. So I would always look at it in the form of an opportunity cost. All right. I had another question over here. And that is, I believe, Nathan, you said that if someone was older, and they might want to trigger it if they were old enough because there might be a forced trigger. Now, does that mean, were you thinking of them passing away, or is there just a point where they might have to sell, like they have to sell?
Yeah, I mean, the forced transfer that I was referring to was what we've been talking about. An individual who has that property, they're elderly, they're going to be passing away, and they don't have any surviving spouse. So that forced realization is really that asset going into the state, and like Stuart said, not only paying capital gains tax, but also attracting probate. So yeah, I think similar to the situation we've been discussing.
Sure, sure. Another question that's come, and then this is probably going to be popular for those people who are listening who are incorporated now. They might not even have any real estate, but sometimes questioning whether it's still worth it to incorporate in general. So let's say they're making $300,000 of income. Now that these changes are coming, there's on the personal side, they have the $250,000 old rules that apply, but corporately, those rules don't even apply on capital gains anymore. What is your guys' opinion on, is it still, an incorporated physician or dentist? Is it still worth it for them to not only incorporate, but to build assets inside their corporation?
I think the first thing that always has to be said with a question like that is everybody's situation is unique. And, they really need, if they're asking that question, it's important that they seek some advice and get somebody to look at their individual situation. Because it's tough to apply a rule of thumb. That being said, when I look at these new rules, I don't see this increase in the capital gains inclusion rate as a game changer for incorporating and earning active business revenue in a corporation. And professional revenue from a dentist or a doctor, similar to a small business,
Good.
is all treated as active business income. And when you incorporate that business, when you incorporate that revenue, you gain access to the small business rate, which is significantly lower than top personal tax rates. So I think the short answer is, for an active business income, whether it's professional income or a small business, I don't think this changes the discussion on should I incorporate, should I stay incorporated. I think, if it made sense before, it still makes sense. If we're talking about, investments, purely investments, again, if it's attached to an active business, I think in general, I don't think this is going to be a big game changer. For a purely investment corporation, like let's say you've got some 3 investors together, they're investing in real estate. The tax calculation for that situation will be different. It will be impacted by this increase in the inclusion rate. But that doesn't necessarily mean it doesn't make sense to incorporate, because tax is just one of many considerations. And Stuart, I know you and I were talking earlier, there are a lot of legal considerations that often will trump the tax considerations.
Yeah, mostly what I was just getting at is if, say, me, Nate, and Christian decided we were going to buy a property together and we were each going to own 50 shares, so we're all equal shareholders, and then Nate decides, I'm out, buy me out, guys. The tax, well, it's still, the shares are a capital asset, the same as the land itself. So your inclusion rate isn't going to, whether you own the shares that have the underlying asset or whether you have a direct interest in the asset, your capital, the capital gains is not going to change. It's going to be the same, as far as I understand. And I'm sure Nate would correct me if I'm misspeaking here, but it's not, they're both capital assets. But what it does allow you to do is, again, it comes back to the property transfer tax issue. So what you're going to have is that Nate could just say, okay, instead of selling you guys the property and changing legal title and incurring property transfer tax, he could just sell us 25 shares each, and there would be no property transfer tax. And we don't have to deal with the land title office, and it's just cleaner to do behind the scenes rather than messing with title and all that kind of stuff, and probably cheaper in that case as well.
I think the one area where you would see a difference, based on the information we have today, which could change, is the 3 of us have that corporation. We have 3 investment properties in there, and we want to sell one of those investment properties out of the corporation. The one difference we're going to see is if we had held that personally and we sold that property personally, all 3 of us would have access to the $250,000 allowance, which would give us the 50% inclusion rate, the old inclusion rate for the first $250,000 per year. So let's say the gain is, $750,000 between the 3 of us. Well, we've got it covered. We're at the old rate. If that property is being sold out of the corporation at this point in time doesn't have access to that allowance. And so that's the one area where, you would have the overall taxes paid would be greater based on what we know right now.
If it was personal.
Well, no, it'd be greater if it was corporate, right? So
No, yeah, but I meant it'd be a greater advantage if it was personal in the scenario you.
Yes. If you're selling that one property personal instead of the corporation selling the property, it's an advantage at that point to hold it personally. But again, that's just one factor. So yeah.
Yeah, it's a unique scenario.
Yeah.
But also keep in mind then too that those people that would sell it in their personal names are the reason they probably have stuff in a company is that they're probably already at the highest marginal rate or very, very close to it possibly. So even though you're paying you'd have a tax in the company as opposed to adding it to your personal income as well, right?
Yeah, it would be taxed to the company at corporate rates with the 2/3 inclusion rate.
With the higher inclusion rate, but if it was in your own personal name and you were paying it, it goes on top of all of your
Yeah,
other income. And I
absolutely.
imagine that most people, and then most people are already at the highest marginal rate, and that's why they have stuff stuffed away in a company.
Yeah, absolutely. And that's where, like, none of those calculations are changing. None of those decisions, it's really just kind of the final sale, and what the inclusion rate comes to.
And they might bring it down too if we have a change in government. I mean, it might just be a waiting game. We might just
Well,
have like, a 3-year period, and then it'll go back down again.
well, and we've seen this government do exactly, come up with big changes, and at the last hour back off. I mean, we've literally seen it, Stuart. We've seen it with the Bear Trust, right? We've seen it. They made big changes to the UHT filing. So,
Yeah.
I mean, we can't even say for sure the information we have today will stand on June 25th.
Yeah, and I think that was going to be one of I'd rather defer it and then cherry pick when is the right time to do it than every year just pay an upfront tax, you know? And I think that's by people who don't incorporate, that's essentially what they're facing. They're saying, I'm not going to incorporate, but because I don't think it's really worth it. But that means you're just uploading and upfront paying this extra taxation, 11 instead of 11% corporate rate, you're actually paying, your personal rate might be as high as 40%. And then all of a sudden now you're paying this upfront tax as opposed to incorporating, where inside the corporation you could build those assets with that, again, on the extra opportunity cost of the money saved in taxes, let it grow. Yes, you're not going to have a preferred rate on that first 250, but you also can choose when you can dispose of these assets. And then if you said, well, what if I kick it out far enough? I need a strategy. Well, that's exactly what the estate bond strategy is there for, the flow through share strategy. Like there is ways to mitigate this problem. And then I love the idea of, let's wait and sort of see if there's a government change. And then that might be an appropriate time to, to free up some assets over that period of time. But I don't think that this problem is going to be so devastating that people should not incorporate or they should trigger and sell all of their assets right away. I think what they need to do is to just do some planning and to figure out what are the options available to me. And I think it's very hard for people to do that on their own, because then they're, I don't know, listening to their friends, or they're listening to one or two sources, something as simple as, oh, I heard that I should sell I should sell a bunch of my real estate assets because I get a lower, I'll trigger a lower capital gains. Well, that's absurd if you were going to hold it for another 20 years, or, I don't think I'm going to incorporate anymore. I make $300,000 a year, but I'm not incorporated because they're changing the tax laws. Like who are you talking? Who are you getting this information from? The best thing to do is to work with a professional to see what your scenario is, and then to give you independent advice as opposed to speculative advice, something that's been analyzed. But I think we're coming to the tail end over here. If there's any last minute questions, feel free to fire it in now. But then otherwise feel free to just reach out to us. If you're listening to the recorded link over here, we're happy to kind of field your questions. We're happy to chat with you. And I want to thank you, gentlemen, for making the time to give us your take on what's coming up next month. And I hope that we could do another webinar again, just to add value to our clients, add value to people who are listening, and to introduce ourselves to those who might need our help.
Sounds good. Thanks, Christian.
All right. Okay.
Christian.
I will talk to you guys soon, and thank you guys for those of us who are joining us today.